Welcome back to Alpha Recap, our post-market rundown here at stockalpha.ai. Glad you tuned in.
Great to be here. As always, if you have questions, you can reach us at stockalpha.ai.
Today we walk through a lot. Big earnings dispersion, a shock sell-off in a marquee name, and a fresh repricing in rates that rippled into mortgages and rate-sensitive stocks.
Yeah, markets closed under real crosscurrents. It wasn't a single theme moving everything. It was more like lots of individual stories pushing prices around.
So, what really stands out here is how concentrated some of these moves were.
Take Tesla. Finished the day down about 14.5% to roughly $320 on heavy volume of about 114 million shares.
That number really jumps out. That was a liquidity-heavy event.
Yeah, that tracks. When a name that big moves that much on that kind of volume, it raises questions about dealer inventory, option positioning, and forced deleveraging. Right, and the other thing is the bond market repriced today too, which amplified pain for high-duration names.
We saw longer-dated Treasury yields move higher, and the 30-year mortgage rate approached about 6.91%, essentially near 7%, and a real affordability threshold.
I mean, when you step back and look at this, mortgage rates near 7% directly hit homebuilders and mortgage lenders, and even consumer demand tied to housing.
And it fed into tech as well. Alphabet slid roughly 7% and finished below its 200-day moving average, which is a technical breach big funds watch closely.
So honestly, I was a bit surprised by this one. Alphabet is a marquee name. A move like that signals a shift in momentum for large-cap tech.
Another bellwether was Micron, down about 18% since its last earnings report, underlining how cyclical memory markets can be.
Right. Memory pricing and inventory dynamics make those earnings highly sensitive to short swings. You get amplified stock volatility when guidance or demand softens.
Short reaction? Wow. Big move.
Short reaction? Right.
Short reaction?
The broader takeaway was dispersion. Not a uniform market decline, but wide divergences driven by earnings and rate moves.
Exactly. Some companies beat and were rewarded. Archer Daniels Midland reported a modest first-quarter earnings per share beat and finished near about $86 after a strong 6-month run.
By contrast, Photronics missed expectations and traded around $30.50, off materially over the last 6 months. A reminder that execution risk is being repriced.
And then you had Riley Exploration Permian, which was up about 31% over 6 months to roughly $36. Energy names still showing idiosyncratic strength.
Right. Sector rotation in action. Some cyclicals outperformed, while defensive names held up too. Verizon beat subscriber expectations and trimmed promotions and finished near about $35.16. And then there was the Berkshire story. Nearly $400 billion in cash at quarter end. At current yields, that cash could generate roughly $14.4 billion annually at about a 3.6% yield.
That is a pretty headline. It changes how people think about the conglomerate's optionality, just on income alone.
Yeah, absolutely. But it's also a reminder. Narrative headlines only go so far without disciplined allocation decisions behind them.
We also talked about the AI narrative being under strain.
AI-themed ETFs and strategies still have inflows, but the realized alpha hasn't uniformly shown up. Some analysts stayed bullish with 12-month targets, but performance has been mixed.
I mean, when you step back and look at this, marketing and product launches can drive flows, but allocators are getting more selective on measurable outcomes.
Right. And the other thing is, the debate between growth and value timing got louder today.
Some investors were adding to names they thought were temporarily unloved. The Salesforce example was cited as a conviction buy despite skepticism, while others trimmed high multiple growth after technical breaks.
And then there's the macro versus micro tug of war. Traders said bond flow and Treasury supply were pushing yields up, while corporate earnings were moving individual names.
That dynamic makes stock selection matter more than broad beta. If you owned the right cyclicals, you were fine. If you owned long-duration growth, you felt the squeeze.
Let's shift into a bit more context on the biggest headlines. Deeper look at the majors.
Tesla's drop was notable not just for price, but for liquidity. Again, down about 14.5% on roughly 114 million shares. That kind of move can trigger stop losses, option gamma events, and dealer hedging dynamics.
Micron's decline is emblematic of how semiconductor earnings can swing on inventory and capex cycles. When demand softens, memory pricing moves quickly and margins compress.
Mortgage rates near 7%. That threshold matters in the housing market. As yields rose, refinancing activity and affordability prospects tightened, and that can ripple to homebuilders and consumer spending.
Geopolitics made headlines too. A Russian strike that cut power for roughly 150,000 people in northern Ukraine, and follow-up strikes raised near-term energy and supply chain concerns.
That kind of headline lifts volatility in defense, energy, and insurance sectors, even if it's not an immediate market mover across the board.
So, what really stands out here is the interaction of these forces. Earnings dispersion, rising yields, and geopolitical noise, all at once.
Which brings us to what this meant for different investor types today.
Short-term traders saw heavy volume and concentrated moves that increased event risk, but also trading opportunities. Momentum can flip quickly with these headline shocks.
Growth investors felt more pain, given rising yields and technical breaches, like Alphabet under its 200-day moving average. Higher discount rates hit long-duration cash flows.
Value and income players saw some relative attraction in defensive, cash-heavy stories like Verizon and Berkshire, but operational execution still mattered.
And sector or cycle investors found energy winners where fundamentals aligned, while housing-linked assets faced clear headwinds, with mortgage rates near that 7% threshold.
So honestly, I was a bit surprised by how quickly some of those rotations showed up after earnings.
Yeah, same. For risk managers, the day reiterated the need to re-examine duration exposure, hedging strategies, and liquidity buffers as yields moved.
Short reactions? Stay disciplined.
Short reactions. Recheck sizing.
Short reactions. Watch technicals.
Okay, let's talk catalysts to watch next. Amazon's earnings and capital expenditure commentary on July 30th will be parsed for AI infrastructure spending and its implications for cloud cost trajectories.
And any change in Fed or Treasury dynamics, like auction demand shifting or new signaling, will quickly touch the long end of the curve, and therefore mortgages and corporate borrowing costs.
Upcoming earnings from other large tech and semiconductor names could either entrench this rotation or reverse it. More post-earnings reactions are likely.
Plus, geopolitical headlines could accelerate volatility in energy and defense if escalation continues.
So strategically, what were the analysts noting today?
They emphasized acceptance of greater dispersion. Stock selection and active risk management mattered more than blanket market exposure.
Reassess duration exposure. Analysts noted valuation compression is a direct channel from higher discount rates, so portfolios heavy in long duration needed attention.
Maintain liquidity and watch margin and option positions. Heavy volume moves on concentrated names can stress leveraged strategies.
And pay attention to technical thresholds and fundamentals together. A breach like Alphabet under its 200-day moving average was both a technical red flag and a reason to re-examine fundamentals.
Right. And the other thing is track macro crosslinks. Mortgage rates, treasury yields, and commodity prices interact with company fundamentals and can accelerate sector re-ratings.
Before we wrap, a few clear takeaways.
1. Today's action underscored widening dispersion driven by earnings and rising yields, not a uniform market sell-off.
2. Liquidity-heavy moves in names like Tesla increase short-term event risk, and bond repricing fed into equity valuations, especially long-duration growth.
3. Sector rotation continued. Energy and some cyclicals outperformed, while defensive and cash-rich stories showed resilience.
4. Analysts were calling for selective allocation and active monitoring rather than undifferentiated positioning.
And remember, this is informational only. This discussion was not a recommendation to buy, sell, or hold any security, nor personalized investment advice.
Final thought: volatility is higher, dispersion is wider, and the next catalysts, earnings, treasury flows, and geopolitics, will likely drive the next leg of market action.
If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening to Alpha Recap. We'll be back after the next close to walk through what changed and why.